Good afternoon, everyone, and welcome to the August 2024 edition of Epic Insight. This is Joe Corona, and I am the Director of Sales and Strategic Partnerships at Epic Retirement Plan Services, and I'll be the host for today's call. With today's Epic Insight, we're going to dive deeper into a topic that has become a very important one for many of our clients, cash balance plans. Cash balance plans can be a challenging concept or topic to become comfortable with, but they also present a great opportunity to be able to cross-sell to your existing retirement plan clients. Cash balance plans allow business owners to defer more taxes while helping to supercharge their retirement savings. But beyond the ability to defer more taxes and to help with retirement savings, these plans can present unique opportunities and ways to be useful as a part of succession planning. To help us navigate this incredibly important topic, we are happy to have one of my colleagues at Epic to help us out. And with us to lead our session today is Carl Willman. Carl joined Epic over a year ago as a senior actuary. He has nearly 20 years of experience administering and designing defined benefit plans, specializing in cash balance plans. He helps companies maximize their retirement and tax savings through qualified retirement plans. He's recognized as a trusted advisor to his consulting clients as well as financial advisors. Carl is a fellow of the Society of Actuaries, an enrolled actuary, and a member of the American Society of Enrolled Actuaries. As a reminder, your line will be muted throughout the call, but if you have any questions that you would like addressed, we ask you to enter them into the webinar control panel and we'll address them at the end of the session. And with that, I will turn it over to Carl.
Yeah, thanks, Joe. We'll get started here. That obviously the slide you're seeing is succession planning with the cash balance plans, and that's kind of an advanced topic with the cash balance plan. So before we dive too deep into that, we'll back up and start with a little bit of basics about cash balance plans for those of you that don't work with them, or a little bit of refresher for those of you that do. So what is a cash balance plan? It is commonly called a hybrid defined benefit plan because it kind of takes the aspects of both 401k plans and defined benefit plans. It's account balance based, so it looks more like a 401k plan than a traditional defined benefit plan, but it still acts like a defined benefit plan and has more robust, funding opportunities. So it's in general, the defined benefit plan has much larger capabilities for additional pre-tax contributions, and that's the main uses here of what we see for small practices trying to add cash balance plans. So why would you want a cash balance plan? Again, it is a defined benefit plan with much larger deductions available compared to a 401k or profit sharing plan. It's easier to understand than a traditional defined benefit plan, right? Everybody would understand what a account balance is of, say, $20,000. That's more tangible to them. They understand what that means better than saying you have a $1,000 a month annuity when you return to age 65. That's very hard to understand, and people will value the things they understand a little better. So that's why it's just a little simplified and a little easier to administer. But typically these are added on top of existing 401k profit sharing plans. We're not getting rid of the 401k. This is something to be leveraged on top of the 401k plan, typically for business owners that already have a 401k and they're maximizing that 401k plan and they're looking for additional tax savings. Their combined plans tested as one, but like I said, they are two separate plans. They're going to have separate plan documents, separate government filings, separate trust accounts. But we look at this as one big retirement plan, one picture, to show that we pass all of the IRS testing rules and for all of the tax deduction needs and retirement planning needs. So we think of the cash balance plan kind of as the owner's plan. They'll get the bulk of their money there. The staff might have to get some benefits there as well to pass all the testing rules. But the 401k plan is really more of the employee's plan. So why would you want to define benefit? Obviously the large contributions, and it's in the name. It's a 401k plan is a defined contribution plan. So the IRS limits what you can put into the plan each year. right? You've got your, was $23,000 is the individual 401k deferral limit, plus catch up, plus you can do employer contributions on top of that. But the IRS says you can't do more than that, right? That's your limit you can put in, and whatever that amount gains to, or if it loses, that's your pot of money at the end of the day. You can take it and you pay your taxes on it, roll it into your other investments when you're done with that account. Defined benefit plan is the opposite. The IRS limits the benefit you can get out of the plan, and the document kind of describes the benefit you can get out of the plan at the end of the lifetime of the plan or of your working career. So that limit is described in the IRS rules as an annual annuity, and if you convert that to a single sum, it's about $3.5 million today. That's per individual, per company, and there's some stipulations on that. You have to be old enough, you have to make enough money, the plan has to be around long enough. But $3.5 million is the target here to show what's potential in a plan. So these are very attractive for business owners that are later in their career and they have a shorter timeline. They can dump in a lot of money here at the very end. So how does the cash balance plan work? Like I said, it's designed for the owners typically. The staff will have to get some benefits, but we'll utilize defined benefits in nature to get much larger deductions and much larger benefits and take advantage of the non-discrimination rules. If you're at all familiar with how the 401k testing rules work, the cross testing, what we're doing here is showing that employees' benefits at retirement age are comparable to the owner's benefits at retirement age. So these work great when there's a big disparity in age between the owners and the non-owners. And so we're going to give the benefits in the cash balance plan to the owner, and then we get to use this compound interest to show that the non-owners get much larger benefits at retirement age, even if they don't ever actually have to realize those interest rates that we're using for testing assumptions. The testing rules is kind of the same idea as a 401k. We're just adding another layer to it, make it a little more complicated, but the same ideas here. So anybody that is a good candidate for the new comparability profit sharing plans may be a good candidate for a cash balance plan. So how much can you get into a plan? This is the current limits for 2024 for 1 year of participation in the plan. So if you had a business owner that was interested in the cash balance plan, you said they're age 55, we'd look at this chart and say that 55-year-old can put up to $248,000 into a cash balance plan. And this could be in addition to or on top of what they're already doing in a 401k. There's nothing magical about the numbers we show in this chart here, although see that it's reduced for age. It gets higher and the older you get. There's a little quirk there where it goes down actually between a 62 and a 65. But if we had extended this chart out, it would start increasing again after 65. We set up plans all the time for people older than 65, even into their 70s, but it's the same minimum distribution rules that apply to 401ks and IRAs. So now with Secure, starting at age 73, they're going to have to start taking minimum distributions. So at that point, maybe it makes less sense because you're not getting as much of a tax benefit if you have to withdraw some money at the same time. But you can see how over a short time here, you can put away a lot of money to get towards that $3.5 million cap today. And again, it can be set up before age 36, but the limits keep going down before that age. And we usually don't see the plans utilized for people in their early 30s or younger, just because the nature of the limits there and the nature of how that testing works out, right? They don't have staff that's a lot younger than them as well. So kind of my kind of rule of thumb is cash balance plan doesn't really make a lot of sense until somebody is willing to put away more than $100,000 into their retirement plan picture here. So that's the quick background. And can it be used as a succession plan tool? Obviously, we're talking about it today, so yes, it can be, but there's some caveats, right? Planning ahead is the key. We'll get into that. We get all the time where, clients or prospects will say, hey, I just sold my business. What can I do? Well, nothing. There's a couple main keys here is that the limits are based on how long you've had the plan in place and one of the key things here is the IRS rule of any retirement plans is permanency. That doesn't mean you have to keep the plan around forever. It just means when you're establishing it, you're putting it in with good faith that it's going to be there for the foreseeable future. So the IRS will crack down on this if they see this, that you're just trying to get a 1-year tax deduction and running away. So it can be, but you got to start in advance. And the whole point is here that the employee or the buyers can fund some or all the purchase price over time in the cash balance plan, right? So we're putting the purchase price or sales proceeds of the sale of a business in the cash balance plan in a pre-tax account. Now, whether that makes sense to that business owner depends on their individual facts and circumstances, right? Kind of the way I think of it is if they need that money to live on, that they're selling this business, then they might be better off with other solutions, right? This is just a tool for you. So maybe the capital gains taxes or whatever else would apply might be less now for them. But if they don't need this money in the foreseeable future, they might want to defer taxes for as long as possible. And maybe their income tax rate's lower down the road. Or if they never need this money and they're going to pass this on to their heirs, then keep it in a pre-tax plan or account as long as possible. But the point is you got to plan ahead, right? There's that permanency rule, but also to get towards that $3.5 million for the principal, for the business owner, you got to have the plan around for 10 years. Those 415 limits that we're talking about are prorated for less than 10 years of participation in the plan. Now, it doesn't mean the plan has to be around for 10 years, but you can see if you had the plan for 5 years, you're only getting, $1.7, $1.8 million potential maximum out of this plan. So you got to get this started early, and you don't have to fund the same amount every year. So we'll show that in a little bit, that you can start at a smaller, modest level and then amend the plan later to put more in at the back end. So case study 1, really simple example here. Business owner with no employees is going to sell his company in 10 years for $1 million. Has current net cash flow after all expenses and everything of $100,000. So he can't just say, I'm going to sell this business for $1 million and put it all in a cash balance plan, right? We don't have the permanency rule, and the limit for this person for their age is going to be quite a bit less than $1 million. They don't have that limit. It's going to be prorated for 1 year participation in the year that they sell the business. So we're going to get this started early. So really simple example here of that $100,000 they've got. Instead of taking it all as income, maybe they take $90,000 as income for years 1 through 9 and put $10,000 into the cash balance plan. All right, there are some minimum participation requirements still that we have to meet. So there has to be some modest benefit level, at least to start off with this plan. And then year 10, they have $1 million of proceeds, and maybe they still take their $90,000 in salary and put the rest of it then into the cash balance by the year 10. And they have $1 million built up over that time plus earnings. And obviously at a 40% combined estimated tax rate, that's $400,000 of tax savings that they're not paying today. Now, that's nowhere near the $3.5 million we talked about, so maybe he could have done this quicker than 10 years, but that's kind of to show if the sale of the business is structured in a way that the income flows through the business, it can be put into the retirement plan as a tax deduction. But we started early, right? That's the point. You can't come to us and say we're selling a business by the end of the year and do this now. You've got to have a plan in place well before that starts. So here's one that gets a little more attention. We see this a little more often, that a younger partner funding the sale of an internal sale of the older partner trying to get out of the business. So 2 partners here, and there's other employees involved, and we'll show here that the younger partner is going to reduce their compensation or benefits and apply that towards the funding of the older partner's account balance in the cash balance plan. Now, because there are employees in this plan, this is going to have to satisfy all the IRS non-discrimination rules. So the employees will get a piece of this additional funding that factors into the overall effectiveness of the plan and see if it makes sense. But we're going to, over time, fund some or all the purchase price, right? So say there's maybe $1 million that we're going to fund in the plan, but maybe that's not the entire purchase price, right? Maybe there's $1 million that they're going to settle outside of the plan. So this is just a tool that can be for a piece of the puzzle. It doesn't have to be the entire solution. Like I said, here's exactly what I said. Older partner is going to sell the company to the younger partner in 5 years for $1 million. Right now, each of them has $500,000 in take-home pay. And there has to be an agreement in place on shifting the profits, right? You have to have the attorneys involved here to make sure everything is lined up and this makes sense. And all the contingencies, what happens if one of the partners backs out, whether health deteriorates, got to have everything involved here. So here's an example where they currently are sponsoring a 401k plan employees. We'll look at that plan first. Here's what they're currently doing. 2 partners is ideal demographics, huge income, only 3 other employees that have relatively small incomes. And so they're each taking their $500,000 of salary. They're each maximizing their 401k deferrals. So younger partner is going to 23,000. The older partner is above age 50 and can do the catch-up deferrals. They're maximizing the DC is the defined contribution. That's the 401k profit sharing. That's the employer contribution part of that. So between any safe harbor or matching or profit sharing contributions, that's going into that bucket. So the owners are already taking advantage of that, and that's about 5% probably of their employees, of the 5% of the employees' pay that's going to the plan to pass all to the current testing rules. So that's ideal. So to do this sale here, the younger partner is going to reduce his salary from $500,000 down to $300,000 and put that $200,000 subtraction into the cash balance plan. Right, so he's really foregoing the income. The company is putting that in the cash balance plan for the older partner. So just different things here. Without getting too technical here, the owners were not able to fully maximize the profit sharing plan. In some instances, with smaller professional practices, there are some multiple plan deduction limits, so they're not able to maximize the profit sharing and do the cash balance plan at the same time. So in this case, their profit sharing is slightly lowered as well, and the staff costs increased, right? That may be double what they were getting before. So they're getting a little bit in the cash balance plan to pass some minimum participation testing, and then they're getting a little bit in the profit sharing plan to pass all the rest of the non-discrimination rules. So kind of just a rule of thumb for adding a cash balance plan as far as staff costs, the employees are going to get somewhere between 7 to maybe up to 10% of their compensation between the 2 plans. So that's pretty typical here. So we went from 5% to maybe, I don't know, 8 or 9 or 10% in this example between the combined contributions to the 2 of them. So this is still a great design, right? Those total tax deductions are extremely large and more than offset any administrative or advisory costs or anything to keep this plan running. So that's a great option there. But the point here is that the younger partner, after 5 years of doing this plan, has funded $1 million with pre-tax dollars, right? The younger partner is not getting income tax on that $200,000 because that's not coming to him directly. That's staying in the business. The business is putting in the cash balance plan and getting the deduction for that contribution. Now, this is just a vehicle for the assets, right? So there's still got to be some exchange of stock for some nominal price outside of the plan. And then again, that's where the agreements with the attorneys and CPAs have to be involved to make sure this is done right. And the older partner, after 5 years, has $1 million in their account in a pre-tax, tax deferred account in the cash balance plan. So after that 5 years, presumably the older partner's out of the business, they can terminate the plan and he can roll that money out pre-tax into another pre-tax account, 401k or IRA. Or the younger partner can keep the plan around, right? You can amend the document to do something different at that point. So younger partner may be accustomed to funding the plan and now has the ability to start funding money towards his own retirement plan and keeping the cash balance plan around. So example 3 here, without any bigger numbers and more technical things, is kind of the very common case here is somebody already has a cash balance plan, right? They had the cash balance plan for the traditional use of a cash balance plan. Over 10 years, they built up $2.5 million for their plan, and they had employees. So the big point of how this all works is the defined benefit 415 limits. He could have had $3.5 million in the plan, but there's a $1 million gap there. So if it's a 1 year sale, you might be able to amend the plan to put in upwards of $1 million in the cash balance plan if the proceeds of the sale come through the business that way, to get all that money in the plan and soak up that gap between what he could have had and what he did accumulate over 10 years. Or another option here that we see is if it's an asset sale, then all the employees go to the new buyer and you pay them out what they're due. And that business owner then can continue that plan under their own business entity that they've kept. And maybe the proceeds of the sale come in over time. Maybe it's structured over a 3 to 5 year period. They're going to put in that money, the proceeds of the sale, into the cash balance plan over time as they keep this open. Again, attorneys need to be involved here. Make sure there's no control group or affiliated service group rules between the entities. It's kind of a red flag to me, at least, if all of the money coming into the old business is only from this, sale of the business or working for the new buyer. But that's pretty common that these asset sales go through and that business owner is still working to some degree, maybe quite a bit less, maybe the income's quite a bit less, but they still have other things they're doing. And it certainly makes sense to keep this plan open, and they can keep this plan to fund quite a bit more into the plan at the very end. So if they had that plan for 10 years, they are at least age 62 to get to that maximum benefit, and they've had enough income over the time, they can soak up that extra money. I guess anecdotally, the first time I put one of these in place was more like example one, where I had 3 siblings that equally owned an RV park, and they knew they wanted to get out of that RV park. They didn't want anymore, but they didn't want to pay taxes on selling that company, the business. So we worked with them and came up with a strategy in advance. Like, you can put some money in this plan, but you can't do it all at once. So they started this plan, and they had whatever their typical salaries were at the time, and they funded the cash balance plan at some smaller level, like $20,000 each. It's relatively small compared to what they, typical uses of cash balance plans are. And then after 4 or 5 years, they sold the company, and for about like $1.5 million. So they each put in about $500,000 into the cash balance plan in the last year. Right? We amended the plan to increase their benefit, put in a bunch of money, terminate the plan, roll all that money out into their IRAs. And that's the ideal scenario, and there's not any employees to worry about, any staff costs. But that's a great solution if that works for that company. So in conclusion, right, that's what we're talking about, is the cash balance plan can be used to do pre-tax benefits upon the sale of a business, and it's got to work. It doesn't work in every situation, so make sure all the stakeholders are involved, right? Consult their attorney, consult their CPA. Sometimes, depending on the way the businesses are taxed, the sale has to be structured in a certain way that the income comes through the company that way. But the key again is start it early. You got to get that clock ticking to take advantage of the larger contributions, and make sure don't get any scrutiny from the IRS for having this plan for too short of a time period. So even in the existing plan, we say the rule of thumb is around 5 years. There's no black and white rule. There's nobody that says that's true, but certainly the shorter the plans in existence, the harder somebody will look at that and make sure it's not breaking the spirit of the law there. So Joe, that's all I got. Were there any questions that came through?
Absolutely. Well, thank you very much, Carl. We'll now open the floor up for a few minutes of questions. So if you do have something that you would like to run by us, we ask you that you enter it into the question panel now. So one question that has come through thus far is related back to your example, our case study number 2. So here is the question that came through about that. The IRS defines the fair market value procedure, so now is the stock price adjusted. This is without determining the investment value or synergy valuation? In other words, how can you adjust the stock price for the younger partner in example 2?
Again, that's a lot of times we have to get the attorney involved, right? So we've got to make sure things are done the correct way. I don't know the direct answer to that question. Again, it probably works best if that's in a combination with doing things outside of the plan. But the stock doesn't really transfer, doesn't happen inside the plan. So that's just kind of our role as the design and administration of the plan, and we got to figure out how to handle that outside with the attorneys and CPAs.
Great. Next question that just came through. Does it matter whether we're talking about a C Corp or an S Corp?
Typically, no, but again, the attorney will have the ultimate answer, but they all can take advantage of this, right? If the sale of the business is structured in a way that the income comes through the corporation, then the corporation can get the tax deduction. Now, I guess most of the time, the small businesses we work with are already have S Corp elections instead of C Corp elections. But that might make a difference if the business is completely shutting down altogether, or if it's going to continue on.
All right. A couple other questions, some not specifically related to the succession planning piece, but related obviously to cash balance plans. Can you talk about, are there certain industries that cater better for cash balance, for offering a cash balance plan as a retirement benefit?
Yeah, the biggest users are small professional practices, especially medical groups, right? It's nothing necessarily in the industry, but it's got to be successful businesses that have strong cash flow year over year. So part of I guess the downside of a defined benefit plan or a cash balance plan is that there are required contributions every year. So this is not really meant to be set up for somebody that had one really strong year, but they don't know they're going to have it going forward. So they got to have consistent cash flow to be able to fund the plan. So medical practices fit well into that. But yeah, I mean, it's professional practices are the bulk of the users, doctors, dentists, lawyers, CPAs. But we've set this up for many other industries. And like I said, the RV park, we've had HVAC companies. So it's all across the board as long as they've got consistent cash flow.
Okay. We obviously have a room full of financial professionals on the call. So one of the questions that came through, can you address some of the parameters surrounding the investments that can be used for cash balance plans?
Yeah, it's typically the same investments you would put into a defined contribution plan, but the caveat is you're not necessarily trying to get the largest possible return in a cash balance plan, right? The cash balance plan usually have some targeted rate of return, maybe it's around 4 or 5%. And it being a defined benefit plan, if you exceed that rate, that might mean you can't put in as much the following year. Your deduction will be less. And if you take the risk for trying to get large returns and underperform, you have to catch it up over time. So typically this is kind of structured that it is a more conservative piece of the overall portfolio, and take additional risk in the outside assets outside of the cash balance plan.
All right, great. A couple more questions that came in, and then we'll close it up for the day. First one, with the funding scenario after a business sale where a large contribution is made, wouldn't employees in the year the business was sold also be eligible for a commensurate contribution?
Yeah, absolutely. If there are rank and file employees in the business and already in the plan, then yes, we're going to have to amend the document to increase benefits to allow the large deduction, and the employees will probably get a share of that either in the cash balance plan or in the profit sharing plan to make that pass all the IRS testing rules. If funding it up makes the plan, I guess, overfunded, more than the benefits are actually promised per the plan document, then yeah, we've got to figure out how to split that excess contribution. Just like any ongoing plan, that excess benefit has to be kind of distributed in a non-discriminatory way. So That doesn't necessarily mean in proportion to benefits of the cash balance plan, but that's usually the goal. But we do have to jump through all those hoops and pass the testing rules.
Great. One final question here on investments within a cash balance plan. The question is related to owning real estate as part of a portfolio that supports a cash balance plan. Are there general guidelines for owning real estate and utilizing that within a portfolio for cash balance investing?
Yeah, it can be done. I personally don't know all the rules. That's not something that Epic deals with a lot. We don't work with plans that have real estate or rental income. But yeah, there's guidance out there to make sure it's done correctly. I guess the big picture is make sure you avoid any of the prohibited transaction rules, right? If it's something that the trustee is trying to, the plan is trying to use this for personal business, that might not work out.
Great. Last two questions that we've got. First one is, are you/Epic able to help consult or run scenarios to determine if this makes sense in particular situations?
Yeah, absolutely. There's no charge for our proposal process. Again, we're not the tax experts, so we can show how the plan can work, but certainly then you'll want to get the CPA involved to see if this solution is the right fit for that scenario.
Next question is related to the use of life insurance. Can life insurance be used to fund the cash balance plan similar to a 412H plan?
Yeah, that's a tricky one. I would say in a traditional defined benefit plan where everybody gets the same benefit level, it can work. In the way cash balance plans are structured, where the owner gets a large benefit that's discriminatory on its own, and we're combining it with the 401k plan for testing, that does not work. Those incidental benefit rules for defined benefit plans are based on the benefit in the cash balance plan being, or the DB plan being, non-discriminatory. So it can work, I would say, in a cash balance plan if there are no non-highly compensated employees. So essentially no owner. So if you've got a plan that only has a business owner, or owner, partner, owner, spouse, then it can be a good solution. But typically it does not work when there are rank and file employees.
Okay, great. And a question on the interest crediting rate. What are the interest crediting rates that we typically use in our plan design illustrations and for plans that we administer?
Yeah, our default is a fixed rate of return somewhere around 4%. It can be a little, we go down to 3, we go up to 5.5 maybe. There are some, you could tie it to an index like the 30-year treasury. That's not as common anymore. And probably, the in vogue thing is to do what's called a market rate of return, where the interest crediting rate is tied directly to the actual interest return of the trust account. But there are some rules around that, right? There's a preservation of capital, so that the cumulative return can never be less than zero. Essentially, they're going to get the sum of their pay credits. And also because some of the way the testing rules work out, and that this $3.5 million 415 limit we're talking about is all based on some assumptions of future earnings, we would have to put a cap on that we usually use about 5.5%. So you're still trying to keep the investments fairly conservative, just like a fixed rate of return plan. There's just a little bit more flexibility with those.
All right, and one last fun question to close us out for the day. We must have a Chicago Cubs fan in the audience, because the question is, since actuaries are experts at probabilities, what is the probability of the Cubs winning the World Series this year? Now, I, as a Yankee fan, would ask that from a Yankee perspective, but Carl will ask you that from this Cubs fan's perspective.
I am a Cubs fan, and I don't think it's very good. I think they lost today, last time I checked, and they've got, 5 or 6 games to catch the Braves with some teams in between. So chances of making the playoffs aren't very good.
All right. Well, we'd like to thank Carl and all of you for joining us for this Epic Insight webinar. As a reminder, we'll be sending out a copy of today's presentation as a follow-up. We wish you safety and health as you support your family, colleagues, and clients. And please do not hesitate to contact us if there's anything that Epic Retirement Plan Services can do to support you and your efforts. We thank you, and we look forward to having you join us for an upcoming edition of Epic Insight.